What is up, everyone? So today I want to kind of update everyone on what's been going on in the oil markets. I know it's been a couple weeks since I made my last video, kind of reviewing what's been happening in the oil markets. I know there's been a lot of things that have come out in the last couple weeks that have really made things pretty exciting in the oil market and has made or pushed Brent oil back above 80 bucks a barrel, which is pretty crazy. And I think WTI is trading around 74 bucks a barrel. So definitely a lot of stuff to go over in this video. And also, even though Brent has rallied back to 80 bucks a barrel and WTI has rallied to pretty much a new high, a lot of the oil stocks haven't really participated in this rally. Some of the like GEN, GF, CRC, some of those oil names have rallied with this, but a lot of the ETFs like OIH, XES have not rallied with this. And that's what I'm going to go into in a bit. I'm going to show you a chart comparing WTI crude to some of those ETFs. It's pretty interesting how decoupled they've become, and I think that presents a very great buying opportunity. I'll probably be looking to add some to my position here pretty soon. So to get started with what's been going on, as you all know, there's been a lot of declines in supply from countries like Venezuela, and that's been going on for like a year plus. That's nothing new. There are Iran sanctions as well. We found out about that about a month ago when Trump said that he would pull out of the Iran deal. At the time, we didn't know how much supply we would lose, but it's the last week has become very obvious just how much we're going to lose, and it's really much more than expected. I did not expect this at all. I thought maybe we might lose maybe max 1 million barrels of oil per day from Iran. There's a report that came out on Tuesday saying that Trump is pushing to limit Iran's exports to zero, like nothing at all. They produce almost 3 million barrels of oil per day as of May, and Trump is looking to push that to zero by November, which is really crazy if he actually accomplishes this, which I don't think he's going to get it to zero. But if he gets it, close or below like 1 million barrels of oil per day, that's still a ton of oil off the market. And frankly, I don't think anyone can cover that amount of supply that's lost, especially when you factor in continuing losses from Venezuela. Also, shale in the U.S. is actually starting to plateau and flatline. Everyone expected that to keep on growing, which I do think it'll keep growing a little bit, but it's really starting to plateau as of the last month. And this is expected to really continue into the second half of this year and into 2019. Like I said, it'll grow by a little bit, but it's really, you're seeing it to start to really plateau, which is pretty crazy because a lot of the government agencies, they forecasted shale to, keep growing, like that would grow like 2 million barrels of oil in like 2019 or something like that. And that's obviously not going to happen. There's a lot of pipeline constraints and takeaway constraints as well. So they're really bottlenecked down there on what they can actually export, and that really amplifies the problem. So back to Iran. Like I said, I don't think Trump is going to get it to zero. That's just really hard to do. Back when we had sanctions on them before, when Obama was president, they were still producing exporting quite a bit of oil, but that's because the sanctions weren't that tight. But what Trump is trying to do is, I think he's going to do a good job. Like anything that he says, he's going to follow through on it. It's just very hard to limit a country to zero exports and get all other countries in the world on board. I think Europe is definitely going to be on board with this. India said that they're going to be on board with this, and they're preparing refineries to halt imports of Iranian oil. China, that's a big question mark if they're going to stop importing Iranian crude. But pretty much all other countries, we have the biggest military in the world, so a lot of these countries, they're going to listen to us, even if they don't want to. So bringing, what they used to produce, which is 2.8 million, down to, I believe it'll definitely be well below 1 million. I don't think it'll be to zero, but it'll be pretty close to that. And just taking that amount of oil offline Trump has said that he's met with like Saudi Arabia and OPEC to cover the supply losses, but the max that Saudi Arabia has ever produced is 10.8 million per day, and right now they're producing right around I think 10.2. So they're expected to bring on about 600K. He's saying that he just tweeted this morning actually that he talked to Saudi Arabia and they're going to produce 2 million more barrels of oil per day. I do not see this. They've never produced that much, and it takes a lot of time to develop new oil fields. So this isn't something that can just be brought on online like that. I'd be surprised even if they do produce like 2 million barrels of oil per day, that's going to be lost by Iran and Venezuela. So no matter what happens, we're still going to be in a deficit. It's just a matter of how much of a deficit we're going to be in going into 2019. We've already seen oil inventories with the report last week has passed below the 5-year average, and that is trending down very quickly. So we're going down below the 5-year average. That's also supported crude prices. Just all factors. Libya, actually, that's another wild card that has really developed in the last week or two. They're kind of going through like a civil war, and it's expected that up to 800,000 barrels of oil per day is going to be lost, and the time frame on when, how long that will be for is still unknown, but that's a good amount of oil. So that there's a lot of factors that are very bullish for oil. The one unknown is how much can OPEC produce and Saudi Arabia produce to cover this. I don't think it's going to be nearly what Trump is saying. He always does this where he says they can, really with anything he does, it's going to be more than what it actually is. But that's the big wild card, is how much can they actually produce. Saudi Arabia has never, going back in their whole, the last decade, last century really, the max that they produce is 10.8 million barrels of oil per day. So getting it above that, if they can do that, that's amazing. That's really not going to cover what's lost from Iran and Venezuela. So that's really the one big unknown, but there's a lot of, very bullish factors. You're seeing a lot of supply disruptions, like I said, from Libya, Venezuela, Iran. There's also a couple other, like Kuwait, that is experiencing some supply issues. So if all that went over your head, that's okay. The oil market is a very complex market with a lot of moving parts into it. But just understand that there are a lot of very bullish factors, and I don't see that many bearish factors out there. And now I want to go into my computer and show you guys the decoupling of a couple ETFs and oil stocks from the price of crude oil that have really not rallied with oil, which I think presents a very great buying opportunity. So yeah, we'll go ahead and jump into my computer for that. All right, guys. So this is a chart of OIH, which is like a oil servicing ETF. It has like a lot of oil servicing companies like Schlumberger, Halliburton, Transocean, things like that. And I'll just flip through a few of these ETFs real quick. So OIH is like oil servicing. XOP, that's more of like shale companies, and that has participated in the rally in oil. XES, that's another like smaller cap oil servicing, kind of moved a lot like OIH. And I think, the servicing companies, those will lag oil a little bit. But it's kind of surprising how much they have lagged. So I'll go back to OIH, and then we'll put in a study here and compare this with crude. Okay, we'll put crude oil. Okay, so as you can see, we'll go back a few years and this will display a lot better, but recently it's really decoupled. You see this, the purple line is WTI, the red and green candlesticks, that's OIH. So as you can see, crude, it rallied last time with crude with a high of like $29, almost $30 per share. And then this last rally right here, it has not participated whatsoever, which is really interesting. We'll go back to 3 year and you can see this a lot better. So, as you can see with this chart, it really, not completely, but it does mimic the price of crude and is fairly correlated with the price of crude. As you can see, like when crude bottomed around 2015, it had a low of about $21 per share. When crude rallied, this actually rallied quite a bit more. So it's not completely correlated, but it is very, in my opinion, and actually if you go back, we'll go back to a 10-year time frame and it's even more. You can see the correlation, like just how much it is correlated. But as you can see, as crude has rallied to 74 bucks a barrel, this thing is still sitting at $26 per share and has not rallied whatsoever with it, which I think presents a great buying opportunity. We'll go back to 10-year, and you can see this decoupling like much clearer. So yeah, back in the 12 to 14 era, oil was hovering around 85 to 110 bucks a barrel, just kind of fluctuating in there in that range. During this time frame, this ETF fluctuated, we'll say from like the low was like 35, we'll say like 37 to all the way to a high of almost $60 per share just before crude oil tumbled. So as you can see, pretty much correlated. Lagged back in here a little bit, then finally caught up. In the meantime, when we had just the awful collapse in oil prices, bottom of below 20, like when oil bottomed in like 30 bucks a barrel, you see that bottomed at $20 per share. And since oil has rallied from 30 all the way to almost $75 per barrel, this has rallied from a low of not even 20 to sitting at 26. So this is pretty insane how little this has moved with the price of crude. And it just shows how negative the sentiment is towards oil and oil stocks. People still don't believe that oil is going to be higher and going to go higher. So I think that's part of the reason why it hasn't rallied. But it's just crazy how little this thing has rallied. If you compare to this should be valued around $35 per share. We'll go to XOP. This is still a 10-year, and you'll see XOP has participated this is like really correlated. The price of oil compared to XOP, which is more of like shale companies versus like oil servicing companies. So yeah, I mean, it's kind of crazy how well correlated these are. As you can see, this has participated in the rally last month or so. So I own this ETF. I'm not going to probably buy anymore just because I think this is fairly valued. The place where I see the arbitrage opportunity is with OIH and XES. XES, just as much as OIH. Like I said, I think, these might lag a little bit in oil prices just because they're servicing companies, and the actual shale companies will, most directly benefit from the increased price of crude, but they shouldn't lag this much because we know that as crude increases and shale production has been increasing for the last year or so, the demand for servicing companies is going to go up with that. So I'm just surprised at how little it's rallied with oil. This one, just like OIH, is like almost identical to OIH. As you can see, crude rallies to 75 bucks, and this thing sits at $16-17 per share. This had a low when oil bottomed at 30 bucks a barrel. This had a low of just under $13 per share, and now it's sitting at about 17. It's kind of frustrating because I do own all three of these ETFs. kind of frustrating that this hasn't rallied, but I look at this as a buying opportunity to add a little bit more, just because I think this represents a great arbitrage opportunity. The fact that this hasn't rallied whatsoever with the price of crude. As you can see, I mean, it's not like in lockstep. There can be fluctuations with. Back in 15, this oil was below this. The ETF was quite a bit overvalued compared to that. I mean, this happens every now and then, but in general, this is going to be pretty correlated. But I think this really just reflects the sentiment toward crude and where it is going. And back in 2014 and 15, that's when oil just started to take a massive decline. And that's when sentiment was still, oil's going to come back. Just give it like 6 months to a year. It'll come back to where it was at $100 a barrel. Obviously, it didn't. It had a low, bottomed around $30 a barrel. Now you're seeing that, I think, right now. Like, people think, oil's been down for so long now. The last 3 years been, $40 a barrel. Oil's never going to go back to $100 a barrel. Well, oil's at $75 a barrel, and crude inventory levels are below the 5-year average. We're seeing supply disruptions all over the world. Spare capacity is at basically zero. Now that Iran's out of the picture, Saudi Arabia is going to increase their production to where they have zero spare capacity left. Shale is flatlining. I'm surprised that people still haven't woken up to this, but when they do, this is going to rally pretty hard. And I look at this as a buying opportunity. The only thing I see happening negatively towards crude, which, you can't predict these things, but the only thing I see is a recession. The economy has been performing really well the last year, since the last one back in 2008. It's been one of the longest bull market cycles, but eventually that's going to come to an end. I don't think that's going to be this year. I see that more late 2019. But no one can really predict that. But that's the only really downside I see for crude. I'll go back to 20-year just to show you a little bit further back for this ETF. And this just shows even more like how undervalued this ETF is right now with where crude is trading at. So this is back in 07. You saw oil just skyrocket to almost $140 a barrel. I don't see that happening, but you never know. That really depends on, how much Saudi Arabia can actually bring online for crude. And then you saw back in the recession, 08, this had a low of around less than what it was here in 2015, but around the same, about $13. This is what I look for when I see a very attractive setup right here, because you're buying very close to the lows. Oil has already rallied, and there's a very bullish setup for oil to at least stay here and, in my opinion, continue this back to close to $100 a barrel. The max downside, very little likelihood of this happening, but say we have a recession here immediately, which I don't see that happening for another at least year. I see downside is $13. That's pretty much the historic low. Back when oil was, below $30 a barrel, the low was about 13. So if you take 17 minus 13, that's $4, and $4 divided by 17, I see max downside as 23%. That comes out to be. Okay, that would suck, but if we see another 08, stocks are going to decline. Just in general, not oil stocks, but stocks in general are going to decline. If we have another 08, in 08, just stocks in general decline 50%. 23% is a lot better than 50%. So I calculate downside as 23%. Upside, well, okay, if oil just stays at, $75 a barrel, which we'll say that as base case, this is a $25, $27 stock. That's a 60% gain. Say the oil rallies, keeps going to $100 a barrel. Let's say Saudi Arabia can't, bring that much online. We'll just say this is, we'll take like the mid-range here, 35. This is a $35 ETF. It's over 100% return. So I know I've been like rambling on here for a while, and I want to, wrap this up, but this really isn't hard. Like, crude oil is not going to go away. Everyone, especially millennials, think that, oil is going to be overtaken by EVs, electronic vehicles here. That's not going to happen for another, at least probably 3 decades plus. Even if every other car that gets sold from now on is electric, oil demand will still go up year over year. This is not hard. Like, when I look at the downside, okay, 23%. Look at the upside, we'll say 50 to 100%. I mean, I don't think that's a very hard investment or a risky investment whatsoever. Yeah, we're getting close to the end of this bull market, but I'd rather be invested in something that has, a max downside. Of course, it can go a little bit lower, but I'll just go off like historic lows. So, I mean, I'd much rather invest in something that has a 23% downside than something that, say we have another 2008 happen, something that has a 50% plus downside. So yeah, I think this is a very attractive setup. That's why I love both XES and OIH. XOP, I own that, but I probably won't be adding to that just because it's fairly valued right now. That's it for this video, guys. I just want to give an update on the oil markets over the last couple of weeks. There's been a ton of stuff that's come out, and I do apologize for not putting any videos out for a couple weeks. Been pretty busy over the last couple weeks, but I want to get back to uploading more regularly, and hopefully, back to a couple videos a week. But yeah, I hope you guys enjoy this video, and I'll see you guys in the next one.